Hello everyone, let's continue our class. Previously we learned several techniques in stock evaluation, and here we have three scenarios to consider. The first one is constant growth rate, second one is first one is zero growth in dividends, and the second one is constant growth rate in dividends, and the third one is non-constant growth rates. Right. And the most popular way for us to get a stock evaluation is to use constant growth rate. And here, let's review that equation. P0 equals D1 divided by the difference between R and G. And actually, we can extend our analysis a little bit by doing a little mathematical or algebra manipulation. And here, if we know P0, then we can figure out what R may be for a stock investment. And here, based on golden growth model, we can solve for R, and R here is equal to D1 divided by P0 plus G. And here we recognize there are two components in future stock return. The first one is D1 divided by P0, and that is so-called dividend yield. And the second part is G, and the G is driven factor, is the most important driven factor for future capital gains. Now let's use one example to demonstrate how we can figure out the future required return for a stock, given we know future dividends and the growth rate. Now, a firm stock is selling for $10.50, and they just paid $1 dividend, and the dividends are expected to grow at 5% each every year. What is the required return? Then we can apply the previous equation. Required rate return equals D1 divided by P0 plus G. And here D1, you would say D1 $1, is that right? Well, that $1 is not D1, it's D0. Company paid $1 of dividend. In order to figure out D1, we need to apply growth rate of 5%. So D1 equals $1 times 1 plus the growth rate of 5%. That gives you $1.05 of D1. And the P0 is $10.50. 1.05 divided by 10.5, that gives you the dividend yield. And the second part of required rate of return is 5%. When we add up those two numbers, we get a 15% of required rate of return. And this slide showed you that this growth rate is essentially the driven factor for capital gain yield for this stock. So required rate of return has two components. First one, dividend yield, and the second one is capital gain yield. And this capital gain yield is equivalent to the growth rate or the constant growth rate of the company. Now, let's consider another scenario where a company do not pay dividends. Right? Let's say D0 is 0. And it's very likely that D1 could be 0, D2 could be 0. Right? If that is the case, how can we use dividend-based models like zero growth model, constant growth model, or non-constant growth models? And in this case, it's impossible. It's virtually impossible for investor to estimate future dividends based on zero dividend that the company has for the current time period. And in this case, we have to switch to other methods. And here we use so-called multiple valuation methods. And here we look at PE ratio or PS ratio. And we use those ratios to help us to get stock price valuation. What is PE ratio? PE ratio equals stock price divided by its earnings per share. So P is stock price, E means EPS or earnings per share. And the estimated stock price would be equal to a benchmark P ratio times earnings per share in the future time period. And sometimes earnings could be negative or 0 for some company. In that case, we might seek help from so-called price to sales ratio, price to cash flow ratio, so on and so forth. And here, estimated stock price, if we know a reasonable price to sales ratio, then we can apply the relation for price sales ratio. And the future stock price equals benchmark price sales ratio times sales per share in a future time period. Now let's take a look at a very simple example to see how we can apply P ratio in estimating stock price. Suppose we are trying to value the company in Activision, a video game developer that does not pay dividends. If the industry PE ratio for this type of company is 20 and you predict earnings to be $2.50 for the coming year, then the forecasted stock price for a year from now, or the target price, should equal to that benchmark P ratio times its future earnings of $2.50. That will give you $50 of estimated stock price or target price of this company. Now it's time for us to make a summary on stock valuation, and here we have 5 different methods to estimate the stock price depending on the individual situation of the company. And the first one is the general equation that we can utilize, and this is a very fundamental and basic formula that fits into all scenarios. Stock price equals present values of all future dividends. This is a general formula, general equation, but practically it's useless because there's an infinite number of items in the equation, but this equation shows a very basic mechanism of getting stock price, which is the present value of future dividends. And to make the general case useful for certain scenarios, we developed several alternative models. The first one is constant growth case, and here constant growth rate could be 0. If that is the case, then we utilize perpetuity mechanism to get preferred stock price. Preferred stock price simply equal to dividend divided by required rate of return. If dividend growth rate is a constant number, or G, then stock price can be estimated based on golden growth model, and stock price equals to D1 divided by the difference between required rate of return and growth rate. And this is so-called golden growth model or dividend growth model. In fixing non-constant growth model, we apply the mechanism of 2-stage model, 3-stage model, and n-stage model. And essentially we discount those highly growing dividends for the first stage and apply the golden growth model for the time periods beyond that, and that is a non-constant growth model. Sometimes we don't know dividends, and because companies don't pay dividends, if that's the case, we have to rely on those valuation multiples, typically PE ratio or PS ratio. And if we know a benchmark P ratio and a future an estimation of future earnings or future sales, then we can get a stock price estimation. And the last equation here showed you the 2 components in required rate of return for a typical stock. That is dividend yield and the growth rate. And the growth rate is driving factor for capital gain yield. After we fixing the stock valuation problem, let's do a little bit more work by looking at the feature of common stocks, preferred stocks, as well as trading mechanism on the stock market. If you buy a stock, guess what? You become the owner of the company. You are the owner of the company. You are the boss of the company. As the boss of the company, you have the rights to receive future dividends. And in addition to that, you have other rights. The first one is voting rights, because you are the boss. And here, a company typically will have many shareholders, and the shareholders will form the board of directors, and the board of directors have the authority to elect CEOs, CFOs, and other executives in a company, right? And so shareholder has voting rights to elect for board of directors, and the board of directors will pick CEOs and CFOs and make strategic decisions for the company. And there are sometimes the common stocks in the same company may have different classes of stock, and typically on the market we see Class A, Class B shares, and those are different classification of common stocks. Typically, founder shares are so-called Class A shares, and founder shares have more voting rights than Class B shares. The typical example is Facebook. The founder of Facebook, Mark Zuckerberg, has more voting rights than other common shareholders, and his share is classified as Class A share, and other shareholders' shares are classified as Class B shares. Although all shareholders have the same rights to receive dividends, but the founders' share have more voting rights. They have more voice in a corporation. And other rights of shareholder has something to do with liquidation, declaring dividends, and the rights to purchase or refuse to purchase, buying new stocks for a corporation. But the most important rights for common stockholders are to receive dividends and the voting rights. And here are some characteristics for dividend payment of a corporation. And when a company makes profits, of course they have capability to pay dividends, but they do not have liability to pay dividend. They don't have to do that. And in some case, company need to keep cash, keep the earnings for future growth. In that case, they may not be able. They may not pay dividends to shareholder because they need the cash flow for future development. And in other case, company wanted to maintain some flexibility for future growth. In that case, even when they don't need it to make future investment, they still keep cash in the company. So dividends can be paid, but it's not a liability, and the company don't have to pay dividends. And here, let's take a look at the tax issues associated with dividends. When dividends are paid, it's not tax deductible for the firm. And when dividend paid to shareholders still need to pay taxes based on dividend income. Right? And some states, most states actually have state taxes on dividend income, and on the federal level, of course, there's dividend taxes. For preferred stockholders, there's some difference in dividend payment policy relative to common stockholders, and the preferred stock dividend has to be paid before dividends can be paid to common shareholders. So the dividend payment for preferred stock is more like a liability in certain circumstances. Right? So if company need to pay dividend to common stockholders, they have to pay dividends to preferred stockholders first. And preferred stock is not 100% equity type of financial instruments. It's more like a hybrid products between debt and stock. And here we can view fixed amount dividend payments as interest paid for a certain corporation's debt, but it's not 100% debt, so it's a combination between equity and debt financing. And for most companies, preferred stockholders do not have voting rights. do not have voting rights because they have privilege to receive dividends before common shareholders. So to make this a fair deal, many companies do not give voting rights to preferred shareholders. Now let's take a look at how stocks are traded on the stock market. Let's say you are interested to become shareholders of Facebook. Then the question is where to buy the stock. And there are two markets. There are two markets on the financial. Available for shareholders to purchase stocks. The first one is primary market. The other one is secondary markets. And it's very likely that investor will buy a stock or existing or shares from the secondary market. And here you do not buy shares directly from the company. You buy shares from other shareholders or existing shareholders. And this can be accomplished very easily by setting up a brokerage account with a stockbroker, and a stockbroker will help you to buy shares on the secondary market, such as New York Stock Exchange or NASDAQ. On the primary market, shareholders can purchase new issued shares from the company directly. Right? And the problem here is companies do not issue new shares on a daily basis. Therefore, it's very likely that when investors need to buy shares, it's much more convenient for them to get shares from the secondary market. All right. So the primary market is a market where new stocks are issued, and it's a place where investor can buy shares directly from the company. But the more common case here is investors buy shares from the secondary market. They buy shares from existing shareholders. Is stock trading a very complicated business? I would say it's not, because with the help of dealers, brokers, you can buy the shares or sell shares that you want in a very convenient fashion. And broker help investor to execute buying or purchasing or selling orders, and brokers have trading seat on the exchange, and they charge commissions to help. They charge commissions to help investor to complete their tradings. And on the financial markets, we have a lot of dealers, and the dealer maintain inventory for certain stocks, so that investor can buy, sell certain stocks in a very efficient, very convenient fashion. Right? Suppose that you need to buy a used car. Where can you get a used car? I mean, you can ask for another car owners, but the more convenient way is to find the dealers, and the dealer can help you to find a car that you like to buy and sell the car that you have very convenient. And the same thing happens on the stock market. And there are a lot of dealers, a lot of stock dealers helping stock investor to get shares that they like and sell the shares they don't like. For the secondary markets, there are two major markets in the United States. The first one is NYSE, New York Stock Exchange. And the New York Stock Exchange, the largest stock exchange in the world, it merged with Euronext, the largest stock market in Europe. In year 2007, it becomes the largest stock exchange in the world. In year 2008, New York NYSE Euronext merged with American Stock Exchange, and this makes NYSE even bigger. On New York Stock Exchange, there are a lot of brokers, dealers, but individual investors are not allowed to trade the shares directly on New York Stock Exchange. Investors need to hire brokers to execute orders. And also on New York Stock Exchange, there are many stock dealers helping those brokers to execute those orders. And also we have so-called specialists on New York Stock Exchange. They serve as dealers on the market. They also trade shares for themselves, and we call them as specialists. So on the floor, on the trading floor of New York Stock Exchange, you will see uh, two types of professionals help investors to execute their trading orders. The first one is floor brokers. They help investors to execute their orders. And the second one is dealers and specialists. They help to maintain the maintain the liquidity of the market, so that the transaction can be executed in a very efficient and a very efficient manner. Nasdaq is second largest stock exchange in the United States, and it's very unique because there's no physical location for Nasdaq. You cannot find a Nasdaq anywhere in the United States. But you can also say Nasdaq is everywhere, because Nasdaq is electronic trading system established by National Association of Stock Dealers and Brokers back to 1970. It's the first generation of internet application back to late 1970. And what NASD did was to link all the terminals across country for those dealers and the brokers, so that trades can execute it through that electronic communication network. And there are three levels of terminals that exist on this electronic communication system. The first one, the level 1 terminal shows medium quotes, registered representatives, and the level 2 terminal shows stop price quotes, the name of brokers and dealers, and the level 3 terminal shows all the updated quotes, and is only for dealers. It's only for dealers. On the Nasdaq, we have a lot of technology companies listed, such as Google, Facebook, Microsoft, Apple, so on and so forth. ECN is Electronic Communication Network, and ECNs arise around the year 2000. And ECNs are so-called electronic communication networks. It's similar to NASDAQ. It's electronic trading system, but it has some improvement in terms of technology, and it imposed threats to largest stock exchanges in the United States back to year 2000 2001. But right now, most of the successful ECNs has been acquired by either NASDAQ or NYSE, become internal parts of those two stock exchanges. Reading stock quotes has been challenging and difficult for individual investors back to 1930s, 40s, 50s. But right now, with the advance in technology, it's very, very convenient for any investor to get stock quotes and other information about a stock that they are interested in. And here you see example on Yahoo Finance. If you type finance.yahoo.com, it will lead you to a finance page on that website. And if you type in the ticker of the company, it will show up. It will show up the stock information as you see in these slides. Right? And here you have a lot of numbers. Previous close, open, bid, ask, beta, so on and so forth. And the most important number that you look at is stop price, $44.09. That is the current stop price on the market. And on the right hand side of this slide, you see a chart showing you the stop price trend during the current trading day. And also you can expand your view by clicking 5 days, 3 months, 6 months, 1 year, 2 year, 5 year, max, so you can see a longer history of the stock trading. And here, if you're an investor, if you want to buy this stock, what a price that you are going to pay. Well, many people say $44.09. Is that true? Probably not, because that is the last traded price. For the next second, for the next minute, stock price is going to change. Right? And here, you needed to look at either bid or ask. Bid or ask. And here, bid price $44.01 and the ask is $44.02. So which one will you take? It depends. If you wanted to buy a stock, remember, if you need to buy a stock, you need to have this transaction happen with the dealer. And on the market, the dealer offering $44.02. So if you want to buy a stock, you take the ask price from the dealer. If you want to sell the stock, then you have to take the bid price, because that's the price that dealer offered to you. If they want to buy shares from you, then the $44.01. The difference between bid and ask is called a bid-ask spread. That is the revenue for dealers for providing their stock dealing businesses. Right. And here you can see more information for this stock, and this stock ticker is HOG, is Harley Davidson Inc. company. It's listed on New York Stock Exchange. And the day range showed you the price range of this stock during the current trading day. It is $43.45 to $44.37. And the 52-week range showed you the 52-week low and high during the last 1 year. The low point was $31.50 and the highest point was $46.88. And the volume here is trading volume as of this 908,587 means number of shares has been traded in the current trading day. And the average volume during the last 3 months was about 2 million shares each every day. And the market cap showed you the total size of the equity of this company. It is 10.11 billion US dollars. And the P ratio based on last year's EPS of $2.55 is 17. And the last number dividend is 50 cents for the last time period, and the dividend yield was 1.1%. Okay, here is a short quiz before we conclude the class. First one is, what are some major characteristics of common stock? And the second one, what are some major characteristics of preferred stock? Please review those slides to find the answer by yourself. Alright, so that's all we need to know for Chapter 7. Chapter 7 is about stock valuation, and I want you to practice on those homework questions. Make sure you are comfortable with golden growth model. Make sure you pay attention to the difference between D0 and D1. And I also want you to know that stock valuation is about cash flow discounting. Right? And you need to know the cash flow discounting mechanism for stock valuation. Essentially, what we were doing here is discounting future cash flows, and for stock, that is future dividends. Right? And we use several alternative methods and models to get a stock price estimation. And you need to practice those alternative models for your homework practices. All right, that's all we need to know for today. And this is the Kevin Zhao, your finance professor at MTSU, and I will see you in next lecture. Thank you.